This is Joseph Trevisani from Worldwide Markets. Thank you all for attending. A rainy, cold, wet, and rather miserable morning here in New York City. And I thank you, of course, as always, for taking time out of your day to listen to what I have to say. Today's topic will be, at least the title, was Euro Angst. I think we're going to have a considerably different year ahead of us than most people think. But let's look at some of the possibilities at any rate. As always, I have a chat up here, so if you have any comments or criticism or anything you'd like to add, please do so. And I will do my best to address your questions in our conversation. What you're looking at is sort of a projection, and I did it very quickly this morning. It was a rather horrendous ride out here for traffic. So my charts are a little bit shorter than they might be this morning. So this is a projection on what the Fed is going to do, in my estimation, this year, the year coming in front of us. Right here is where we are, 0.5%. Everyone, and I mean everybody, if there's a person who doesn't believe that the Fed is going to raise the rates a quarter this Wednesday, it's because they are simply don't know that the Fed is even thinking about it. Everybody else, I imagine, thinks that the Fed is going to raise rates. I am sure that there are people somewhere in the world who are not aware of this, and probably many of them, and perhaps they are lucky. We will reserve judgment on that. Nevertheless, the Fed's going to raise rates this 14th. But what about, and that's already priced into the market. It is very interesting. Let me show you this mark. Let me show you this chart. Where are you? This is U.S. equities. And this is going to be pretty much the general thrust of my argument here today, although not specifically related to equities. The date I have on the chart, of course, is the American election. From 1,800 points, the market has gone up since the election of Donald Trump. That's one reason. And you may, I'm sure people have their own opinions about the election of Donald Trump and what his administration may portend for the U.S., for the world, or anything else. Nevertheless, you can certainly see that whatever else is involved in its judgment, the markets think it has a good chance to provide growth, upside potential for the U.S. economy, and by default, of course, the world, still the biggest economy in the world, for the next year, year and a half, something like that. One thing that's not on this chart, but is also true, is the upward projection in Fed funds rates. And not only Fed funds, let's take a look at this. So remember, from November 7th on, we have the, where's my 10-year? Here's the 10-year. Okay, this is the 10-year. No coincidence what that date is. We know what that date is. That is November 7th. So the equity estimate for an economic boom, a stock boom, positive results from the election coincides exactly with higher rates. Now, I started my write-up for this particular session by saying, in the first line of my write-up was, are Mario Draghi and the ECB governors the last true believers in the economic benefits of zero rates? It's a pertinent question because what we're seeing in front of us, so this back here is the taper tantrum, right? That so-called, rather aptly named, I thought. Back in 2013, Mr. Bernanke first started talking about remember Mr. Bernanke, the former Fed chairman? First started talking about the possibility of the central bank easing off, not even raising rates, but of course that was the logical conclusion of the logical endpoint, but easing off the quantitative easing purchases. So now we have a similar type of rate move. And in fact, right now, this move right here, although it's much shorter, has not gone as far because the 10-year which is probably the most pertinent of all the rates for setting market rates. And I'll show you some more. Pretty sure I have, oh, I did not get the 30-year mortgage. Again, sorry, folks. On my way to work, I travel up the West Side Highway. We work in Jersey, and our office is in New Jersey, across the river from where I live. I live in Manhattan. And on the way here, there was just, it's raining heavily here in New York, and people don't really seem to drive very well in the rain. So it took me much longer to get here. I would like to put up 30, but you're seeing a similar type of rise in rates. The point is, the speculation has been, although you don't hear much of it now, and I heard something this morning though, how much higher rates can the equities tolerate before it starts to affect equity prices? Now, equity prices are not the most important economic fact in an economy. Economic growth is, and many other attendant factors, but without economic growth, then none of the other factors come into play. So if the economy is a discounting measure for economic growth, then the rise we've seen in the Dow is anticipating economic growth. You can make your judgments about why, but it's difficult to gainsay the fact. Another fact we must conclude is that higher rates, at least that we've seen so far, are not inhibitory for economic growth. And where does this lead us? Well, it leads us to the conclusion which I have spoken about many times over the past few years. And that is, although the zero rate policy of the Fed and others, of course, was justified at one time, it ceased being justified 2, 3, even 4 years ago. And that the greatest drag on economic growth in those years was, or one of the great drags, I shouldn't say the greatest, was the false pricing of capitalism's basic commodity, the cost of money. And whatever else you can say about this, it is certainly true that, at least so far, and we've only had a month and a little more to judge this, that the anticipation of higher rates has not damaged prospects, at least judged by the equities markets, for economic growth. So that leading to that, now in this, of course, we have Japan as well. The reason I haven't included Japan is because nobody paid attention to the Japanese example. Apparently the Japanese example didn't matter. And so when citing potential influences on the ECB, that's why I'm not citing Japan. Japan has not been successful in ending its zero rate policy. The US, I think, is going to be. Now remember what the yield curve, the rate graph looks like for the 10-year. It's much higher in the past. Nonetheless, the conclusion we must take at this point, at any rate, is that zero rates are not inhibitory. No, excuse me, that higher rates are not inhibitory. We can't yet prove, and I don't know if we'll ever be able to prove, that zero rates were inhibitory. You're certainly going to get a tremendous amount of resistance from the Fed, who is still viewed in some sort of priestly caste as knowing everything there is to know about the economy, which, as far as I'm concerned, could not be farther from the truth. The Fed operates, and you've heard this from me again many times, within an atmosphere and environment of its own bureaucratic certainties and its own bureaucratic reputation. So it's highly unlikely that the Fed will ever come out and say that zero rate policy, although maybe it was effective and necessary in 2007 to 2008, 2009, 2010, 2012, 11, ceased being effective sometime thereafter and became a drag on the economy. That is my view, but I doubt you'll ever hear that from the Fed. Now, there are, of course, when we look at the boom in equities here, which I just had up, this is not only, or maybe even primarily, the effect of equities. I mean, of the rise in U.S. interest rates. There are many political factors weighing on this chart as well. There's no doubt, and we must talk about these political things because they are part of this chart that we're looking at. Some of the policies of the outgoing administration, the Obama administration, whatever you want to say about the purpose and the morality, if you will, of the policies, they were no doubt a drag on business. Certainly the healthcare plan was a drag on business. The regulation coming out of all quarters, pretty much of the federal government, were a drag on business growth. So, excuse me, the prospect of those, just to mention two, of those policies being changed certainly has had a positive effect on the change in equities since the election of Donald Trump. But we can still say at the same time, since rates have gone up at the same time, that the prospect of higher rates, and I don't think anyone is actually looking just here, right? This is the rate projection that I put together just briefly on the way here. Hang on a sec. Now it's only to the end of next year. Okay, since we're still so far away from normal rate policy in the Fed funds, and most businesses, certainly capital intensive businesses, have a much longer lead time and planning time than just a year. But this is what I'm projecting. One rate increase here, another one here. So basically 3 increases in 2017. Well, actually there would be 1, so that would be from 75 to 1, 1 to 2, and that's 1.5. So that would be in 2000. Well, let's just take it from here. So that would be 1, 2, 1, 2, 3, and then 4, including this year, which would get us to 1.5%. If the market feels that the U.S. economy will withstand this, then the commercial rates, the 10-year, the market rates, will race much ahead of what the Fed is going to do. So my guess is if you get the Fed, certainly on Wednesday, talking about strengthening the economy and all the types of Fed speak that leads one to think that they're going to keep raising rates, and I think they are, of course. And I have long said that the Fed needs to raise rates regardless of what they think the rates are doing, because it's the only way you're going to get the economy and business to make commitments on the future. This is an issue and a point of view that the Fed seems to have completely missed. Now listen, the Fed is not a very good prognosticator. In fact, they're a terrible prognosticator. They are very much swayed by their own policy. The Fed has consistently overstated growth. They have consistently understated inflation, and they have consistently understated their own ability to return rates to normalization, whatever that is. So my guess will be that not only will the Fed be, has the Fed been erroneous in their projections on the upside, my guess is they'll be erroneous in their projections on the downside. That means when and if the Fed, the economy does start to accelerate beyond 3% growth, of which there's no sign of right now, all you have is a higher stock market. That's all you have. The GDP growth projections in the United States, you might be wondering where does this lead back to with the Fed, but I'm going there in about 2 seconds. The Atlanta Fed projections in the US are still running, I think, about 2.6% for the fourth quarter. They were 3%, 3.2% was the growth in the third quarter. So all in all, you're still looking at about 2% growth, in a little bit more perhaps, in the year of 2016. I don't see any projections out there yet that are really use for 2017. If, however, you do get growth accelerating beyond 3%, even up to 4%, you know, as a non-economist, myself and others, everybody else here, I'm assuming, it seems like, it does seem like a big deal from 3 to 4%. But in fact, the amount of wealth and income that generates for the country is absolutely enormous. So that small moves in overall GDP are hugely, hugely important. Or to use a modern, I won't use the word because I don't like it. So if you get that, the Fed will end up being behind the curve. And I think they're going to be seriously worried about being behind the curve because they're looking at the stock market. Stock market, discount mechanism for the future, so we hope. 1,800-point boom on the election of Donald Trump. Does that mean that the economy is going to start growing at 4 and 4.5%? If it does, then the Fed is woefully behind the curve in their rate policy. We're going to hear about this on Wednesday. The only thing that's going to be important and of note to the market on Wednesday when the Fed does its rate increase, I think it's Wednesday. What's today, the 12th? Yes, Wednesday. Will be the projections, the dot plot. In fact, I love it when the Fed says, oh, this is not a projection, you know, don't use it as a projection. I mean, how could anybody on the Fed not think that the market would use it as a projection? One of the detriments that we have seen in all sorts of government bureaucracies over the past generation is the rise of the academic expert as the go-to answer for all types of problems. And what you get are people making judgments on the economy who've never honestly participated in the economy. And what do I mean? I mean that economies are determined by the decisions of business people. That's by and large who creates the jobs. That's who founds companies. And these are not people with academic, by and large, especially on the small business side, because I know quite a few people whose livelihoods are tied into small and medium-sized businesses of their own creation. You need, and these voices, business, even if it's only corporate, need a voice. Not only does it need their voice need to be expressed, but the people from academia woefully, desperately need the advice of people from business. If there had been somebody on the board, on the Fed board, one of those Fed governors, who'd ever done something besides live in government bureaucracy and go to academia, then they would have known, they would have understood that zero rate policies, in addition to their supposed effect on the economy, on their nice, neat little equations, have a negative effect when it comes to business people making decisions. So as far as the stock market boom, this is another one of the reactions that you're seeing to the incoming administration. There are business people involved in this, in the policy role in this administration. That is something clearly the stock market is comfortable with. Okay, now how does all of this about basically US rates and everything like that and US growth have to do with the ECB? Excuse me for a minute. Sorry about that. The ECB's policy has been determined on the efficacy of zero rates. And I think the Fed has been, or the US economy at least, has been busy demonstrating that that is not true. Now, the ECB has many other considerations on its mind, but it's going to be difficult for the ECB to project a positive economic result from zero rates, given the evidence in front of it. The assumption of the markets have been, and here's a look at the ECB at various rates. No, it's not what I'm looking at here. Oh, sorry, where's my euro? My euro, US equities. Okay, here we go. This is the year, this is a, oops, sorry, I gotta put that up. This is a chart of the euro and the rates, okay? The Fed funds is in yellow and the euro rate is in green. And I mean, the European rate is in green and the euro is in, that's the candle chart. The euro rate has been predicated on rate policy. The ECB has been doing its quantitative easing, although calling it something else. And the Fed has been for a year now anticipating higher rates. So needless to say, the European rates come off. But the last ECB meeting was a bit of a puzzle. The ECB said that it's going to reduce the amount of bond buying, I think from 80 to 60. If I remember, it might have been 84 to, yeah, 80 to 60, I think. But it's going to extend the period by 3 months. So that is of two minds. What can one mean and what can the other mean? Well, my guess, this is, I think, out in front, and the reason why I'm projecting this is that the ECB is understanding, as the Fed, I think, is understanding, that negative rates are counterproductive. They don't act in the simplistic fashion that their very unsimplistic economic equations predict. And the ECB, I feel, may be preparing itself to reverse policy. And that would have certainly put a completely different cast on the view forward. If the Fed is really going to begin to continue, and I think they are, I don't see what choice they have, to raise rates throughout the next 2 years, is the ECB going to be in any position to let the euro fall below parity? Because, I mean, it will. Is that really where they want to go with this? My guess is they won't be. Now, you're looking at what the market is telling you about, the currency markets is telling you about projected rate policies. But currency markets certainly provide yourself with lots of reversals very quickly. Now, even if the ECB decides to go through this route and is considering perhaps, and I don't know what else to make of this particular statement from their last policy meeting, there are other considerations involved here, and of course they're political. It has been, this is the, yeah, that's not particularly useful. Okay, do we have this chart up here? Yes, we do, one sec. Okay, same chart. Now, what have we seen in the past year? Now, past 6 months? Well, we've seen the Brits, the British, reject the European Union. We have seen the Americans elect Donald Trump, and we have seen the Italians reject essentially the government of Matteo Renzi. Two of those, the first and the last, have rather profound implications for the European unification project and what is coming in the current year. Well, we have an election undetermined at some point. It will probably come in 2017 in Italy. We have an election in France between the National Front and I believe the old Gaullist party with Francois Fillon. And we have an election in Germany. The trending power, the trending politics in all these countries, in the UK, in the United States, in Italy, in France, and in Germany, are trending to a far more powerful voice for nationalist economic policies, if you will, or trending away from the strength of international agreements and international unions. And you must consider the European Union as yet an international union. I know that that's not the concept in Europe, that it's a, or at least as they hope, that it's a union, a European Union is practically a national entity in itself, but I think we're finding out that it's not. It's certainly been the vote that we've seen, and it is quite possible that running through this election, the ones that are pending, Italy, France, and Germany, that whoever wins these elections, and I'm not going to make any predictions on that, I do think that the strength of the anti-EU, anti-Euro, and perhaps anti-globalist viewpoint is becoming much, much stronger. It will get a voice in government. It will have an effect on policy. Now, how does this factor back into the ECB? Well, the ECB clearly pays attention, as with the Fed in this part here from almost all of for the first 6 months of 2016, the Fed has paid the first 6 months of 2016, the Fed paid a great deal of attention to the effect of politics and economics around the world. So central banks, of course, do pay attention to this. Not just finance and economy, but politics as well. And I think you're going to see there's going to be great pressure, I think, on the EU, if not in public, but certainly in its own estimates, to keep rates low, to do what it can to ameliorate these kinds of pressures. So the ECB is going to be truly on the horns of a dilemma. And how they handle it is something that we're going to have to watch for signs for this year. Now, the place we can start, of course, is elections. I forgot to look up the dates of the elections. I apologize for that. Italy's undetermined. They have just put a new government in. The president of Italy asked the finance minister, I forget if it was finance minister or not, I can look it up, but I don't want to distract it, to form a government. Which was a foregone conclusion. They were not going to call for elections because the trend in Italy is for this five-star movement, which probably has an equal weight in polls with Renzi's center-left movement, or center-left party. The five-star movement is a wild card. They've never had political power. They're run by an ex-showbiz type, a man named Beppe Grillo. They think of themselves more as a movement. They have some leftist and some rightist planks or tendencies, if you will. No one knows what to make of them. But the Italians had just passed a electoral reform, which I don't know if anyone knows I'll do the background quickly. The history of Italian post-war governments, but in 70 years, they've had about 60 or 62 or 63, I think, governments. It's very difficult to maintain a governing coalition in Italy because of the proportional representation of their parliament. So every little tiny party gets members in the legislature if they achieve a certain amount of votes. And so you have endless coalitions, none of which have any power because they have to satisfy policy prescriptions from many different points of view of the political spectrum. So this new reform had granted 340 seats in the legislature to any party that scores at least 40% or more of the vote, meaning they would be able to form a majority government in the legislature and thereby govern effectively. Well, this was put in under Matteo Renzi and his center-left party with the idea that in the next election, that would be them. They would be the party who would get this benefit, and therefore they would be able to govern as a unified government. Well, now that they've lost basically the national referendum, which is what it was, on his government, and they're running no better than neck and neck with the five-star movement, which is hardly even a political party. Meaning that if they ran on a national campaign, it's quite possible, and certainly conceivable at any rate, that the five-star movement would get 40% of the vote. Well, if they get 40% of the vote, what does that mean? That means the five-star movement can form a government. So now the Italian establishment is scrambling to get some court someplace to invalidate this new campaign stipulation, this new election stipulation, so that five-star doesn't win the next election and gain control of the government. Well, I mean, for a country that just voted roundly to criticize the current government in a referendum that had nothing to do with that. The referendum was actually on a constitutional change in the upper house to basically neuter the power of the Senate in Rome, which turned into a vote of confidence, basically, or no confidence in the government, then probably the worst thing that I think that the Italian establishment could possibly do would be to try and negate this reform which they just put in simply because it looks like they won't be able to use it, like it'll go to the could go to the five-star movement. So the possibilities for, and one of the things that the five-star movement has said that probably gotten more attention than anything else is that they would put the euro up for a referendum, which leaves them on the cusp of a difficult decision in Italy. Polls, whenever there are some, and there have been some polls on this, I don't know how recent they are, on whether Italians want to remain in the euro, it's somewhere between 15 and 20% only say they want to leave. So 80% say they want to stay. However, there's never been an anti-euro argument made by a party running on a national level in Italy. The Italian economy has essentially not grown since the advent of the euro. Italian unemployment is around 12%. It's probably higher. Italian youth unemployment, that's I think 18 to 25 and probably extends up into 30, is somewhere around 40%. This is this creates huge damage for the economy. You have almost a whole generation of people, 40%, who by the time they're 25 or 30 haven't acquired both the practice and the experience of a full-time job. This is unheard of in a modern Western economy. So it's not something that can be taken lightly. So the idea that a national party that made some of these arguments and blamed some of these economic problems on the euro, justifiably, I think, in some cases, although I'm certainly not going to make that argument now, means that there's a far greater chance that the anti-euro, perhaps anti-EU cast of the opposition in Italy will be far more effective in the next election than anyone anticipates. So the security that the Europhile, or you could say Europhile, I guess, establishment side on the continent, and certainly in Italy, takes from the polls, I think the very least is probably misplaced. So again, back to the EC, the ECB. So we have that in Italy. And although it's not of the moment, meaning that there have no elections have been set and there's no campaign running, there's a new government in Italy appointed by the president, who's going to try and form a government, I think. Still, it's in the background. In France, I think the election's March. No, I'm not sure when the election is. For Fillon and Marine Le Pen. Marine Le Pen's view is anti-euro. It's certainly anti-euro. And it's very dubious of the benefits of the European Union. It's certainly against the immigration policy essentially imposed upon the EU by Germany. Because once people get inside the European Union, they're allowed to travel at will throughout the European, the Schengen zone, I think it's called. So that's an issue behind this as well. So you don't only have economic issues. So you have in France a election with one side being an anti-euro party. the National Front. So you're about to have elections, probably in 2017 for both, but at least for one, in which two parties, two nations, central to the EU. If you're looking for the economic sizes in Europe, I think it's Germany, France, and Italy in the European Union, in the Euro, where one side of a national election is going to be contested by a party which is anti-Euro. The idea that this doesn't have an impact on the decisions of the ECB, I left out Germany, which I'll deal with in a second, but much more briefly, which doesn't have an impact on the decisions of the ECB, is of course, preposterous. It does. So the euro is going to be very much at the mercy of politics. The ECB can't make a good argument for raising rates, can't make a good economic argument for raising rates. I mean, the U.S. doesn't have a great argument for raising rates either economically. Inflation is rising, but not strongly. There's still plenty of deflation out there. The economy is growing, at least this year, 2.1, 2.2%, what it grew the year before. Wages are not rising. 2.5%, I think, is the average hourly earnings on an annual basis. That's barely more than inflation. So the economic argument of an overheating economy, of potentially incipient inflation, are simply not there for the Fed. Yet the Fed is determined to raise rates. So it's kind of showing the way for the ECB. I mean, the Fed has the ability to point to the stock market, but European stock markets have done reasonably well as well. So even though the argument, the economic argument, waiting for the economy to boom, or at least to really pick up under the beneficial effect of zero rates, hasn't happened because beneficial effects are lacking. The economy has not, in the US or anywhere else, has not remotely gotten stronger based on zero rates. Certainly nothing, I think, to what they might have considered. So the ECB is caught on a dilemma this year about what to do. And I'm not quite sure how they're going to play this out. The ECB is a lot more timid than the US, and for obvious reasons. They have a much more complicated political system, and they have, I don't know if they have a good deal less power, but they have a good deal less unification in their national makeup of the ECB. So the effect is not uniform. And we've seen this. This is a flaw of the European monetary system. But it's not one that they can fix right now. So we have the ECB torn this year, I predict, between, because it seems to me that this last split decision, and split, I mean the policy pointed in two different directions, by the ECB is depicting a split amongst the governors themselves about what's the proper path to take here. Certainly the Germans, were probably the most influential members of the European community and the European monetary system, monetary union, have long thought that zero rates are not an effective tool for dealing with the European Union's and the European Monetary Union's problems. Now, I don't think it's true that the conclusion that they'll come to, nor the Fed's conclusion, that we immediately have to bring rates up to a historical level. That would be foolish and would precipitate a recession. That's not going to happen. But if, at least for a year or two, the result of higher rates in the US does not turn to be damaging to the economy, does not turn into retardant on economic growth, in fact, turns into being a positive for economic growth, then it will be impossible for the ECB to look at that and come to any other conclusion that what's good for one is probably good for the other. It will be impossible for the ECB to look at that and say that our policy is correct, that economically based, that we need to continue zero rates because it provides economic benefits to our member nations, meaning the members of the European Monetary Union. So the only thing likely in 2017 to be keeping the ECB where it is on interest rates is political concerns. At least I can't come up with any other logic. So if that is true, then the ECB will never acknowledge it. They won't. I don't think they'll say specifically, we're worried about the elections in Italy and France and Germany. So this is the crux of what we're talking about for ECB policy and Euro angst in 2017. It's why I started my write-up for this, my brief on this, with the question, are the European governors, the ECB governors, the last true believers of the economic benefits of zero rates? And I don't believe they are. Because it's impossible, where we are right now in the global economy, in the US economy, it's impossible to look at the record of zero rates and the projections into next year, at least of those from the stock market in the US and elsewhere around the world. It's impossible to continue to believe that zero rates or very, very low rates are a benefit to the economy. I think we've seen and witnessed a rather astonishing experiment, reckless one might say, but perhaps not, by the central banks. And one thing we must remember about central banks, they are often portrayed, and often unfortunately portray themselves as omnipotent or close to it, at least all-knowing. They're not even remotely close to it. We certainly know that their projections are no better and often considerably worse than other people in the market. Their biases are inherent in their policy in ways that I'm not even sure they quite understand, at least as a corporate entity, even if the individuals might understand. And so the reason that Mr. Bernanke, to lead the way on this, and the Fed governor those days, chose zero rates was because that's all they had. Central banks essentially have one tool, and it's interest rates. And quantitative easing is nothing more than interest rate policy taken a further step, but it's nothing more than interest rate policy. But the problem is, once you are in that box, and since your brief is supposed to be taking care of the economy, you look to the economy for indicators to tell you to stop this policy. But if the policy itself creates a drag on the economy, then you never end up getting signals, because your policy, whatever its necessity back in 2008 and 2009 and 2010, maybe a little further, no longer serves the purpose. It's like I use the analogy, although I haven't used it recently, of quantum mechanics, the idea of physics, where the act of measurement intrudes upon the measuring. Or put it another way, that at very, very small distances, nano distances, atomic distances, the rules of Newtonian physics of the world that we live in don't apply. And it may be, and I think we're seeing pretty strong evidence that it is true, that the interest rate mechanics, lower rates, better for economic growth, higher rates, retarding economic growth, don't work below a certain level. Certainly where we are now, at 0.5% in the US, and 0 in Europe, and essentially 0 in Japan, are past that threshold. This has never been tried before, so the result, of course, was experiment. The policy and the result were experimental, but I think the evidence is pretty much in now. We've got a decade, close to a decade running on this. And zero rates don't promote economic growth. I think we've seen this. I mean, the evidence was always there. The reason I left out Japan in this discussion was because the Japanese evidence has always been there, but nobody was paying any attention to it whatsoever. And so it didn't seem pertinent to include it in this discussion. So this is the ECB's dilemma going into 2017. I think they are realizing that economic rates at this level are a detriment to the economy. But how do they get out of it? Because they have a more complicated situation than the Fed. The Fed does not have any essentially political considerations. I haven't heard once someone saying the Fed should lower rates because Donald Trump has been elected. But the ECB will be hard pressed, if not to admit, at least to think that the French, Italian, and German elections are not dangerous to the European Monetary Union. And that's their dilemma for 2017. Can the ECB start raising rates by whatever justification they find necessary in the face of politics to benefit the European economies? I don't know. I don't really have the answer yet. We'll be seeing it over the next months and perhaps years. But it's going to be the chief discussion, I think, at least through the first half of the year. Okay, folks, I thank you very much for attending. We will do this. I think we're doing this again on Friday. I'll have to check. I'm not sure what the date is. I'm doing an end of the year discussion. So check on FX Street to see what the date is. I'll put my email address up there. FX Street will send it out. I thank you all very much for attending, and I'll see you at the next webinar. Thank you.